Okay, let's talk about another form of a liability called payroll taxes. And most of us are going to be very, very familiar with this because of the deductions to our paycheck. But there's another side of this that we want to think about now from accounting perspective. First of all, let's do the part we do know. We understand that we're going to get gross pay. That's total compensation earned by the employee. That is in terms of your paycheck. We're not going to talk yet about benefits and that type of thing later in this lecture here. First of all, it's wages, salaries, commissions, bonuses, anything that can be a take-home pay after taxes here. Again, we won't count vacation. Most cases you can't cash out vacation unless you quit or under certain circumstances, but basically these are things that can translate into disposable income for you and your family. Net pay obviously is the gross pay minus deductions, and we call that take-home pay. Most of us are very familiar with that, and we don't like those deductions, but here's what happens with them. Okay, first of all, withholdings are what the IRS calls them, and what you'll see them as on your pay stub. These can be voluntary or required. Typically, you're going to see federal and state income tax or Social Security tax. You'll have some voluntary ones here. You can take out extra money from your pay for retirement purposes or for a 529 plan to fund maybe a son or daughter's college fund, and you can also be deducted union dues if you so choose. You can make contributions to charitable organizations. So there's all kinds of voluntary deductions. Interestingly enough, if you are a member of a union, if it's a closed shop where you are required to pay union dues, it shows up as a voluntary deduction, even though you may or may not have chosen to do it. Very interesting term about unions. I've had hundreds of dollars, thousands of dollars taken out of my paychecks for what was called voluntary deductions, and I did not want to be part of that at all. But there you go. It's an interesting environment. The employer obviously withholds the money. They're responsible for getting it to the proper fund or organization, just like sales tax. Okay. So here is what happens typically, right? My page numbers may not be right because this was done with a different book. So I think actually this is on page 375 is where this starts. So please excuse my page number error there. Federal income tax depends on the number of allowances, often associated with the number of dependents you have, and it obviously depends on your weekly pay. All right. Social Security, known as the Federal Insurance Contributions Act, has two parts. Social Security, you take out a fairly big chunk, 6.2% of your first $107,000 of salary, typically. And if you make money above that, there should be no Social Security deducted. All right. These caps do change, and you will see problems both online and in your book and in these online materials here where the caps are different. So you have to use the numbers they give you in the problem, even though this is 2010 numbers here, the $106,800. Medicare, I think stands for old age social, I forget the S, disability insurance, but this is typically uncapped. They take 1.45% of your total salary, no matter how much or how little you make, and so that's how Medicare typically works. All right, so those are the two biggies for Social Security and Medicare. How we calculate net pay. Obviously, you take your gross pay, you take your federal tax from Exhibit 3, and that is in your book. I think depending on which book you were using, you'll go look at that tax table, and you have to understand the number of deductions, and you have to take those deductions out of your federal income tax, and I believe that is on page 390 of most of your books. Okay, it's called Exhibit 9A.6, the wage bracket withholding table. Okay, so you need to know how many allowances are claimed. That runs across the top, and then you look at your weekly pay down the left-hand columns. You find the row and column that fits, and that's where you go get your federal income tax. Okay, understand that this is a weekly tax table, which is absurd to me because almost everybody gets paid bi-weekly or monthly, and so you may need to double that number to really find the federal tax withholding for a 2-week pay period. Okay, you'll calculate your Social Security and Medicare costs here. You will include any voluntary deductions, and then at the end of the day, you obviously will have your net pay. All right, so what happens here is this, right? Here is the employee's gross pay, the true salaries expense. This is where the biggest number would be, obviously. All these credits have to add up exactly to equal that one debit. This is the true gross pay of the employee The bottom one here is your net pay, right? The smaller all these deductions are, the more your net pay. The bigger they are, obviously, the less your net pay. Okay, so if you have any union dues, that deducts from it. The bigger your medical insurance deduction might be. Okay, if you have full coverage, maybe you have no deduction here, but most people have full coverage, quote unquote, and they still have some extra contributions you've got to make to get the benefits that you want. Okay, and that's becoming more and more a reality as healthcare costs increase. Federal income tax payable, that's what happens. The money goes to the feds for your federal taxes. I have left out state taxes here because some states don't have it. California does. Okay, but then you have your Social Security and your Medicare right there. So all these deductions, sometimes they add up to 25%, maybe more, 30% of your check. And then this bottom number here, salaries payable, is actually your take-home pay, your net pay. All right, that's what the journal entry looks like. Here's a piece that many students don't understand unless you've owned a business. All right, whatever those two numbers were, I'm going to go back one here. These top two numbers especially, your Social Security tax and your Medicare tax that the employee pays out of their paycheck, these exact numbers are matched by the employer. So this is an added expense above what the employer pays to employees. Okay, so they have to pay those exact dollar amounts to the feds for Social Security and Medicare. Most employees aren't even aware of this. The employers are. Okay, so they also have unemployment tax. This is state unemployment tax, usually 5.4% of your gross pay up to $7,000. And then your federal unemployment tax, known as SUTA and FUTA, or as my controller says, SUI and FUI. These are 0.8% of your gross pay. The federal is usually not capped. Okay, so this is what these look like. And notice this is not on the employee's paycheck at all. This is a journal entry the employer has to make. This is a very real expense, and this is true for every employee. That last journal entry was just for one employee. We were looking at your dollars, how much money you make, how much your take home is, and all that. This is a new journal entry that the employer makes to the feds, and they have to actually recognize this expense, pay these monies out occasionally. I don't know if it's quarterly or if it's monthly, but most places I think are going to do it monthly. But this is a very real expense that is exactly the same dollar amounts as on the employee's paycheck, but it is a second entry. So really what the employee sees being deducted for Medicare and Social Security, those numbers are doubled because this is another journal entry of equal dollar amounts that the employee never sees. This is one of the reasons why employers are moving more and more to contract employees. They don't want you to be an employee because they have to pay these things along with unemployment. Okay, here's unemployment tax. Here's more unemployment tax. Usually the state is bigger, and this is a big deal right now with high unemployment because these unemployment funds that are collected by the state and the feds, these are being tapped very heavily. So the more that employers lay off employees, the more people make benefits claims. And so those funds are very under stress right now, and it's not clear how much longer there will be unemployment dollars available for people seeking them. All right, benefits and vacation expenses look a little bit like this. If the company has to pay these, so they're very real, and so if you say $10,000 for an expense for one employee, maybe his medical costs are $4,000, maybe he's got retirement of $6,000. The employee may match some of this, but the employer usually pays for these in cases where you have benefits and retirement. Obviously, this is becoming less and less likely in this economy. Fewer and fewer employers are paying these costs, so we hope that you guys have a very real cost for a very real job that can pay for these things. Vacation costs coming up. Employees are paid for 52 weeks, but they work fewer than 52, so the difference is a real cost that must be journalized. Let's take a look at this one here. Suppose the employee works 50 weeks a year and makes $62,400. They really are only working 50 weeks a year, so at 52 weeks, okay, they'd make $1,200 a week, but really they're only going to get paid for 50. Well, they do get paid the full time, but actually a difference of $48 must be journalized each week. In other words, the employee is going to take home their whole salary, but really they're not earning all of it. Some of it you're giving it to them in a form of vacation. So you've got to recognize in this case, $48 per week must be journalized or accrued. And so this person sets up $48 per week, and that's a liability on the company's books. That's a benefit for the employee, obviously. And so there's a very real expense right here that actually builds up the vacation. You've all heard the term accrued. This is one of the first places where employees, I think, learn the word accrued. It's an accounting term, but you want to build up your vacation. You want to build up your sick time. You want to build up any other benefits you have. A lot of times you can't take vacation in the first several months that you work because you haven't accrued enough. Okay, so this is why it's accrued. You actually are accruing it each week or every 2 weeks in a biweekly pay period, and that's how that works. All right, there's more. If you have a defined benefit plan, a company takes the liability risk depending on how long you collect retirement dollars. In other words, there's a pension. We don't know how much, or the company doesn't know how much you're going to collect because they don't know how long you're going to live. It's a very real cost. Okay, it is a cash cost. Notice we will credit cash. Cash goes down as that expense accrues. And if they do not have the cash to cover it, they have to recognize an unfunded pension liability. This is a big, big deal, as public agencies as well as private companies may have too little cash that they've set aside for employees who retire and are living longer and longer. So this liability clearly builds up a big debt on their books that they can't cover, and some companies do fold their pension funds. They get taken over by the federal government, and people who've been counting on retirement sometimes don't have the retirement they thought. They may have pennies on the dollar. So be careful. Watch very carefully what your company does with your pension fund, with your retirement fund. Strongly recommend that everybody has their own retirement plan in place, whether that's a 401k, whether that is a tax sheltered annuity, whatever you've got. Make sure that you are putting aside something, because fewer and fewer companies are able to cover pensions and retirement funds. One big deal here about all these things, we haven't even covered sick leave and that type of thing, but if an employee makes, say, $60,000 a year, that's their gross pay on the company's books, the true cost of that employee is usually 20 to 30% above the gross salary. So let's just say 30% or a third. Let's just make it I'll make it a quarter. 25% of that 60K, which would be $15,000. The true cost of that employee is probably 75K. And if you're making 80K, maybe 1/4 of that pushes you up to $100,000 is the true cost. So if people think that an employee's salary is the cost to the company, they're grossly mistaken. And people need to realize that having employees is very expensive. As our controller told us, watch out for anything that eats. And that's what the business people are telling us, that you want to make sure you manage your head count. You want to manage your employee costs very, very carefully, because even if you were to lay people off, even if you were to downsize, those severance packages, those types of liabilities and costs are still going to be expensive to the company. So it's much, much easier to have contracts than it is to have employees, and that's where a lot of companies are moving. May not be good for the employees, maybe fewer benefits and vacation time and retirement funds for employees, but this is one of the reasons why people say it's so difficult to do business in California. These costs are a little bit higher in California than in neighboring states, so it's something to consider. Income taxes. The company, the employee, actually does collect the income taxes from your paycheck. That's why you don't see them in your take-home pay, and they actually have to make sure those dollars get to the feds or the state here. So on April 15th, actually, I picked that date because that's our date. Companies do this quarterly. They actually do have to send the cash to the government in a journal entry that looks like this. So here's a liability, income tax payable, and they actually have to write that down once a quarter by sending the cash to the government here. That date is probably not likely. That's the date that we use for our personal income taxes, but companies do that quarterly. Okay, I will get into these practice problems in a separate lecture, and we will go over that in just a moment.